Welcome to This Explainer. Today we are grabbing our notes and diving straight into Chapter 6 to uncover the really rigorous, sometimes downright fascinating process of gathering airtight audit evidence. So, if you've ever wondered how auditors systematically prove a company's financial statements are actually accurate and reliable, well, you are in the exact right place. We're going to break down the methodology that transforms raw, messy data into a verified financial reality. Okay. Here's our game plan for today. We'll be looking at 1. What is audit evidence? 2. Sufficiency and appropriateness. 3. The 7 audit procedures. 4. Classifying the procedures. And finally, number 5, testing management assertions. Let's just jump right in.
Section 1. What is audit evidence? Setting the foundation for our financial investigation.
Right, so let's set the stage here. Just like a detective needs absolute, irrefutable proof to close a case, an auditor relies heavily on what we call audit evidence. The official standard, ISA 500, literally defines this as all information used by an auditor in arriving at the conclusions on which the auditor's opinion is based. Now, keep in mind, this isn't just about glancing at a few final receipts. It's the whole ecosystem. We're talking internal accounting records, checks, invoices, contracts, and even information carried over from previous audits. It's everything.
And you know, evidence isn't just some box you check off at the end of the year. It is an intensely cumulative process. You're building your case from the very first preliminary engagement activities, pushing through your risk assessment, and continuing right up to the exact moment you draft that final auditor's report. Every single step of the audit generates critical proof, and it all layers together to form a complete, accurate picture of the company's financial health.
Section 2. Sufficiency and appropriateness. The golden rules of evidence gathering.
Now, the absolutely crucial point for any auditor is balancing these two intertwined concepts. On one side, you've got sufficiency, which is simply a measure of quantity, having enough evidence. But you have to balance that with appropriateness, which is all about quality. This asks, is the evidence actually relevant to what we're testing, and is it highly reliable? Because here's the thing, you absolutely cannot compensate for poor quality evidence just by gathering a mountain of it. To make a definitive ruling, you need both. So, what actually dictates how much evidence you need in practice? Well, let's say an inventory clerk is known to make errors. The risk of misstatement in that department is obviously much higher. And because that risk is elevated, you're going to need to gather a significantly greater volume of proof to bring that audit risk down to a level you're comfortable with. Conversely, if your evidence is incredibly high quality right out of the gate, you might actually need less of it overall to reach a really confident conclusion.
Speaking of quality, how do we actually judge reliability in the real world? Well, going back to our notes, remember this core principle. Evidence that is gathered directly by you or obtained from an independent outside source on original paper documents is always going to be your most trustworthy proof. Think about it. A bank manager sending you a confirmation letter directly is infinitely more reliable than a client just casually handing you a photocopy of their bank statement, right?
Section 3. The 7 audit procedures. Opening up the financial detective's toolkit.
ISA 500 outlines 7 specific procedures that truly form the foundation of audit fieldwork. We're talking about everything from inspecting tangible assets and observing internal processes in real time to making direct inquiries of management and seeking out external confirmations. It also includes recalculating numbers just to check the math, reperforming client processes, and running complex analytical procedures. Auditors weave these diverse tools together, often mixing and matching them to build a rock-solid case.
Now, a crucial part of inspection is understanding the actual direction of your testing. The directional flow between a source document, like a vendor invoice, and the final accounting ledger completely changes what you're actually trying to prove. It is a two-way street, and picking the right lane is literally critical for the audit's success.
Let's break that down for a second, because it's a super vital practical concept. Vouching means you start at the ledger, the final numbers on the books, and you track backwards to the original receipt. This proves the transaction actually exists and isn't just some fictitious revenue made up by management. Tracing, on the other hand, goes the exact opposite way. You take a stack of original receipts from the warehouse floor and trace them forward into the ledger. That ensures absolutely nothing was left out, successfully proving completeness.
Moving on to another incredibly powerful tool, confirmation. When you ask a third party, like a bank or a major debtor, to confirm a balance, you generally have two choices. Positive confirmations require a reply from that third party no matter what. Negative confirmations only ask for a reply if the third party thinks the stated number is wrong. But here's the catch. A non-response to a negative confirmation might just mean the letter got lost in the mail. Because of that, positive confirmations are pretty much always considered far more persuasive.
Section 4. Classifying the procedures. Knowing when to use your tools.
So now that we have these 7 tools, we need to categorize them. Procedures like observation and inquiry, those are typically used first for risk assessment. This happens right at the very beginning of the engagement. You're scouting the terrain, identifying potential areas of material misstatement before you ever dive into the deep numbers. It perfectly sets the stage so you know exactly where to focus your most rigorous testing later on.
Once those preliminary risks are assessed, we move on to what our notes call further audit procedures, and these divide nicely into 2 distinct buckets. First, you have tests of controls, where you're checking if the client's internal safety nets, like, say, requiring 2 signatures on every large check, are actually working as designed. Second, you have substantive procedures. These are your heavy-duty, direct tests designed to catch actual, hard-dollar errors in the financial numbers themselves.
Let's pause for a second. With all these fantastic tools at your disposal, and all these classifications like risk assessment and substantive testing, you might be wondering, how on earth do auditors actually match the right procedure to the right account balance? How do they know what exactly they are trying to prove in any given scenario?
Section 5. Testing management assertions. Proving the claims behind the numbers. Here's the secret. When management hands over their prepared financial statements, they aren't just handing over cold numbers. They are basically making implicit and explicit assertions or claims about reality. By putting $1 million of inventory on the balance sheet, management is confidently asserting that the inventory actually physically exists, that the company legally owns it, that the records are perfectly complete, and that the inventory is valued correctly.
And this brings us right to the core of the auditor's job. The fundamental task is to select specific procedures brilliantly designed to test these distinct assertions. You see, you don't just broadly audit inventory. You test the existence assertion of inventory by physically observing it in the warehouse. You test the valuation assertion by pulling invoices and recalculating its cost. You are systematically proving or disproving management's claims, point by point by point.
So, I want to leave you with this final kind of thought-provoking question to chew on. Since an auditor ultimately has to rely on their own subjective, professional judgment to decide if the evidence they've gathered is both sufficient and appropriate, how would you ensure your own future audits remain truly objective? It's a fascinating challenge, and it's really at the heart of the whole profession. Thanks for joining me for this explainer. Keep reviewing those notes and stay curious.